A big headline hits, you rush to get in, and you fire off a market order to buy at $50. You click, and a heartbeat later the confirmation comes back, filled at $53. $3 whole a share you never agreed to, and on 1,000 shares, that's $3,000 gone in a blink. You didn't get hacked, and nobody reached in and stole it from you. In the split second between your click and your fill, the market simply moved out from under you. That gap between the price you see and the price you actually get has a name: slippage. On a calm, quiet day, it's barely a single cent, a rounding error you would never even notice. But in the wrong moment, like this one, it can quietly gut an entire trade. So let's catch it in the act on one simple price ladder, one rung at a time. To see where it comes from, think back to the price ladder. The price on your screen is just the best offer in the whole market at this one exact instant. But that offer is only good for the shares actually sitting there, waiting right now. It's a snapshot of the very front of one short queue, frozen for a single moment in time. Behind that front rung there are more sellers, but every one of them wants a little bit more. So that headline price was never a promise for your whole order, only for its very first slice. Let's make it concrete. Say you want 1,000 shares and you want them right now. So you send a market order, which means one simple thing: fill me now, whatever it takes. Now look closely at what is actually for sale on the other side of the book. At the very front, only 300 shares are being offered at $10 each. Behind them sit 400 more a cent higher, and behind those, 300 more a cent higher still. Now watch what your market order does, because it takes whatever it needs to get filled. First, it grabs all 300 shares sitting at $10, and it empties that front rung. But 300 is not 1,000, so your order is still hungry for more shares. So it climbs to the next rung and takes 400 more, this time at $10.01. That is 700 filled, but it's still not the full 1,000 you asked for. So it climbs one last time and takes the final 300, up at $10.02. Now you're full, but watch the average price you actually paid drift upward the whole way. It started at $10 flat, and it settled a full cent higher at $10.01. So let's add up what just quietly happened to you. You saw $10 on the screen at the moment you clicked buy. But on average, you actually paid $10.01 for every single share. A single penny sounds like nothing until you multiply it across 1,000 shares. That is $10 whole simply gone, that you never agreed to pay anyone. That is slippage, your average fill landing worse than the price you saw because your order was bigger than the best rung. Now be careful here, because this is not the same thing as the spread. The spread is something you could see coming before you ever place the trade. It's the gap between the bid and the ask, sitting right there on the screen, the known toll. Slippage is a completely different animal altogether. This is you not even getting the price you already saw with your own two eyes. Think of it this way: the spread is the price that's printed on the menu. Slippage is the bill arriving at your table, bigger than the menu ever said it would be. And here's the part that surprises people: size is not the only way this happens. Even a small order for a single share can still slip on you. Because in the split second between your click and your fill, the market itself can move. You aim at $10, but by the time your order arrives, the best offer is already $10.03. So there are really two different doors that lead to the very same bad fill. One door is your order being bigger than the shares waiting at the front rung. The other is the price simply drifting while you wait, and that second door opens for orders of absolutely any size. So what makes this little gap grow from a penny into something that really hurts? It comes down to two forces that often work together. The first is a thin book. When only a few shares rest on each rung, your order has to walk much further to fill. The second is a fast market. When the price is moving quickly, it drifts more in the time you have to wait. And nothing brings both of those forces together quite like a piece of news. Picture the exact instant an earnings report or a rate decision hits the wire. Traders yank their orders back, the rungs go bare, and the price leaps several levels in a single second. Which is why slippage is often at its very worst, in the exact moment you feel the most urgent to act. And this isn't just theory, because the futures market has already shown us the extreme version. On May 6, 2010, regulators traced a sudden market-wide crash back to one automated sell program in the biggest American stock index future. That program was set to sell 75,000 contracts, roughly $4 billion worth with no regard to price or time. And it was done in about 20 minutes. Buyers simply vanished. The resting buy orders in the book collapsed to less than 1% of what had been there that morning. The future dropped more than 5% in under 5 minutes, and the final stretch of that fall took just 15 seconds. Then the futures exchange paused trading for all of 5 seconds, and that alone was enough to bring buyers back. But the panic had already jumped into stocks orders that had to fill at any price got exactly that, with some filling at a penny and others at $100,000. That evening, the exchanges canceled the most extreme trades, and markets have since added automatic brakes against this kind of spiral. It almost never gets that bad, but that day was exactly the two forces you just met. Turned up to maximum, and the accelerant was the order most people set to protect themselves. And that leads us straight to the part that really stings. Think about the order most people use to protect themselves, the humble stop-loss. The moment its price is touched, a stop-loss quietly turns into a plain market order. And it gets triggered in exactly the worst possible conditions, a fast and falling market. So it fills by walking down the book, taking whatever worse price it can actually find. The very tool you set to cap your loss can hand you the deepest slippage of all, right when you need it out the most. Simply knowing that one fact is already half of handling it well. So what can you actually do about all of this? There is an order built for exactly this problem, the limit order. Instead of saying fill me now at any price, you name the worst price you are willing to accept. A buy limit at $10 means $10 or better, and never a single cent worse. No surprise fill can ever sneak past the line that you drew. But there is a very real catch here, and it matters. Your limit order might simply not fill at all. You get your 300 shares right at $10, but what about the other 700? They sit and wait patiently in the queue, or they never come to you at all. So step back, and you'll see the whole thing is really just one simple choice. A market order hands you certainty that you'll trade, and uncertainty about the price. A limit order gives you the exact opposite, certainty on your price, but no promise you'll trade at all. It is speed or it is price, and you almost never get to keep both of them at once. So the real question is always which one you value more in this particular moment. When you must be in or out right this second, you pay for it with slippage. And slippage, in the end, is simply the honest price of choosing speed. So here is the honest truth to carry with you. You cannot erase slippage completely. Anyone who takes a price right now pays a little something for that privilege. Once in a great while it even breaks in your favor, but you can never count on that. What you can do is work deliberately to shrink it down. Trade deep in liquid markets, where the rungs are fat. Keep your size small against the book. Step aside around the news and reach for a limit order whenever the price matters more than the speed. Slippage isn't a bug to be fixed, it's a cost to be managed. So the next time the price on your screen and the price on your fill don't quite match, you'll know exactly why. The number you see is only ever good for the share sitting at it, and only for the single instant you saw it. Everything your order reaches beyond that simply eats the next price up the ladder. Learn to really see that ladder, and your fills will stop surprising you. And next, we're going to go one full layer deeper into the book itself. We'll ask what really decides whether that ladder is deep and safe, or thin and dangerous, the hidden size behind the price. So what should we pull apart next? Tell us in the comments below.